Are Bitcoin treasury companies a systemic risk to Bitcoin? The short answer is no, not currently and potentially not ever. But this fear is spreading fast and it stems from a fundamental misunderstanding. So let's walk through why that fear exists and why it's misapplied. Bitcoiners are suffering from a kind of immune response. After a decade of scams and 100x leverage retail blowups, it's understandable. From Celsius to FTX and BlockFi and others, every time there was leverage, there was collapse. But today's environment is different. We're not talking about offshore margin platforms anymore. We're talking about publicly traded US companies that have to file with the SEC, that are governed by traditional finance rules. This new cohort, Bitcoin treasury companies, is strategically applying low liquidation risk, intelligent leverage to deploy capital into Bitcoin. And that is the key difference. As Michael Saylor points out, it's impossible for traditional companies to generate or take on leverage that these crypto companies did. You might get 20% leverage, maybe 30%, but you cannot get 10x leverage. Saylor's own firm is just levered 1.2x. And even then, he notes that their bonds are 50x over collateralized and still can't get a credit rating. Why? Because traditional finance still views Bitcoin as a zero. The idea that Wall Street would allow companies to pyramid 10x leverage on Bitcoin is laughable. These are not crypto companies. They're US public companies operating in an extremely conservative credit environment, particularly when it comes to Bitcoin. The debt markets will hardly give them capital. The only entity that's been able to raise capital in the debt markets is Strategy. So where does the capital come from? Equity. And here's the first major point. Equity financed Bitcoin accumulation is not a systemic risk to Bitcoin. It's a risk to shareholders. If the trade goes poorly, the stock price gets crushed. The company can dilute, but none of that forces Bitcoin onto the market. It actually acts as a buffer. And here's another point that's rarely discussed. Only 6 of the top 15 Bitcoin treasury companies are even actively running a public Bitcoin treasury strategy. The rest are miners or companies that hold Bitcoin on the balance sheet because of their operating business. People are seriously overestimating how large this market segment even is. And when it comes to actual leverage, we're years away from it even mattering. A lot of these new entrants haven't even started accumulating. Others are still a year away or more from executing their first ATM at the market equity raise. The real leverage wave, if it happens, won't arrive until 2027 or later. And by then, Bitcoin's market cap may be well past $3 or $4 trillion. The treasury segment would have to scale massively just to become a systemic force, let alone a systemic risk. But let's entertain the bear case anyway. People say eventually one of these treasuries is going to overextend, use too much leverage, and be forced to liquidate at the bottom, catalyzing the next crash. And to that I say, again, no. First, because most of the accumulation is not leveraged, it's equity driven. And second, because the incentives don't support that outcome. Let's unpack this. Smaller treasuries benefit from the Bitcoin upside. So if you're a small company buying $10 million of Bitcoin, a 10x gives you $90 million in gains. You don't need to take on debt. Your equity re-rates organically. And latecomers can't break the system. So if a company shows up in 2026 trying to catch up to MicroStrategy with leverage, they simply won't be able to raise enough capital to become a systemic player, let alone a systemic risk. They'll accumulate a marginal amount of Bitcoin, but not enough to crash the market even if they dump it all. Accumulation also begets accumulation. So when these companies buy Bitcoin, they reduce float. That helps the price rise. That makes it easier for the next company to raise capital to buy even more. That creates a reflexive floor in the market where each new buyer strengthens the price base. And public equities also absorb volatility. This is the most overlooked fact. If things go wrong, the company's stock sells off, not their Bitcoin. The equity absorbs the volatility, acting as something of a shock absorber for Bitcoin's float. And the same thing goes for derivatives that company were to issue. So let's zoom out. Wall Street is going to borrow dollars to buy Bitcoin because it works. As long as Bitcoin's compound annual growth rate over any given duration is higher than the cost of capital at that same duration, this trade is wide open. Borrowing at 5% or even 0% to buy an asset that's currently compounding at 30% is just rational capital allocation. It's not degen. And Wall Street will run this trade at scale until one of those two conditions disappears. But neither is likely in the short term. And in the meantime, the fears about systemic risk are a distraction. The real systemic risk is being underexposed to Bitcoin while institutions buy the float out from under you, one SEC filing at a time. That's all for today's video. Thank you so much for watching. If you enjoyed, make sure to like and repost, and of course, follow for more, and check out Horizon. Horizon lets you stack Bitcoin using your home equity without taking on new debt, extra monthly payments, interest charges, or term limits. You can check that out at joinhorizon.com or by scanning the QR code right there. That's all for today's video. Thank you so much for watching. I'll talk to you soon.